Stock Market Outlook 2025. Potential rebounds and investment opportunities. The promise of a market rebound. After a blockbuster 2024 that saw the S&P 500 soar by an impressive 28.3%, investors are now turning their attention to the prospects for 2025. Despite the overall strong performance, a surprising statistic has surfaced. Approximately 30% of the index's stocks underperformed, leaving investors wondering whether these laggards might be poised for a significant rebound. Companies like Nike Incorporated have garnered attention from market watchers, with experts suggesting their potential for recovery could be a key driver of investor returns in the upcoming year. This article delves into the factors shaping this outlook, highlights opportunities in the market, and provides actionable insights for investors looking to capitalize on the potential rebound. Analyzing the 2024 performance. Winners and laggards. The S&P 500's robust 2024 performance was fueled by strong consumer spending, a resilient labor market, and the Federal Reserve's gradual pivot toward dovish monetary policy. Tech giants and growth-oriented sectors led the charge, contributing heavily to the index's stellar 28.3% increase. However, not all sectors shared in the success. Consumer discretionary, healthcare, and some industrial stocks underperformed, weighed down by supply chain disruptions, inflationary pressures, and lukewarm earnings growth. Nike Incorporated, a well-known leader in the apparel and footwear industry, exemplifies this underperformance. Despite a solid brand reputation, the company faced challenges such as inventory buildup, shifting consumer preferences, and macroeconomic headwinds. These issues caused its stock to lag behind the index. However, analysts suggest that these setbacks are temporary and that Nike's strong fundamentals, including global brand equity and strategic investments in direct-to-consumer initiatives, position it well for a rebound in 2025. The disparity between top-performing stocks and laggards underscores an important theme for investors. Markets are rarely uniform in their growth. This segmentation creates opportunities for those willing to look beyond headline indices and identify undervalued opportunities with growth potential. 2025 Rebound Factors. Why underperformers might shine. Investment professionals are optimistic that several 2024 laggards, including Nike, could see a reversal of fortunes in 2025. One driving force behind this potential rebound is the easing of inflation, which is expected to stabilize consumer spending patterns and reduce operational costs for companies across various sectors. Additionally, many underperforming companies have implemented strategic changes aimed at strengthening their market positions. For Nike, this includes a renewed focus on digital sales channels, innovation in product lines, and expansion in emerging markets. Another factor boosting confidence is the cyclical nature of markets. Historically, stocks that underperform during a bull market often catch up in subsequent periods as investors rotate their portfolios. With interest rates projected to remain steady or decline slightly, capital is expected to flow into sectors that lagged in 2024, such as consumer discretionary and healthcare. Companies in these sectors could benefit from renewed investor interest, driven by improving fundamentals and attractive valuations. Finally, global economic recovery continues to support long-term growth prospects. In emerging markets, rising disposable incomes and urbanization trends are expected to drive demand for consumer goods, presenting additional opportunities for companies like Nike. This broader economic context suggests that underperforming stocks may not only rebound but could also outperform the broader market in 2025. Actionable insights for investors. Investors looking to capitalize on the 2025 rebound should focus on diversification and fundamental analysis. Consider allocating a portion of your portfolio to underperforming sectors with strong growth potential, such as consumer discretionary or healthcare. Within these sectors, look for companies with solid balance sheets, innovative strategies, and a history of weathering economic downturns, Nike Incorporated being a prime example. It's also critical to stay informed about macroeconomic trends. Keep an eye on inflation data, interest rate decisions, and global economic indicators, as these will significantly influence market performance in 2025. Tools like MarketWatch and Bloomberg can help you track these developments and adjust your strategy accordingly. Additionally, Leveraging ETFs focused on specific sectors or themes can provide exposure to a diversified set of stocks, reducing risk while maintaining growth potential. Stock Market Outlook 2025. Top brokerage picks to watch. The rise of brokerage giants in 2025. As 2025 begins, investors are looking for strategies to navigate a volatile yet promising financial landscape. Amid the noise, two names are shining bright on analysts' radars: Charles Schwab and LPL Financial. These top retail brokerage picks for 2025 are expected to capitalize on strategic adjustments and leadership-driven innovations to achieve significant growth. Whether it's Schwab's efforts to reduce short-term debt or LPL's potential for margin expansion under new leadership, both companies are poised for a rebound that could redefine the retail brokerage sector. In this article, we'll break down why these brokerage giants are making headlines, explore their growth strategies, and provide actionable insights for investors seeking opportunities in this space. Charles Schwab, redefining stability and growth. Charles Schwab, a household name in the financial services industry, faced a challenging 2024 marked by tightening profit margins and elevated short-term debt. However, analysts are optimistic about the company's potential to rebound in 2025. Schwab's management has announced plans to aggressively reduce its short-term debt, which should lower interest expenses and improve financial stability. This strategic move is critical in restoring investor confidence, especially in an environment where rising interest rates have pressured profitability. Another key factor driving Schwab's rebound prospects is its focus on achieving its net interest margin (NIM) target. With the Federal Reserve signaling a possible pause or slight reduction in interest rates, Schwab is well positioned to benefit from a more favorable interest rate environment. Achieving its NIM target could lead to a substantial boost in earnings, providing the financial flexibility needed to reinvest in growth initiatives such as technology upgrades and customer acquisition strategies. Moreover, Schwab's robust client base and innovative offerings, such as commission-free trading and advanced digital tools, position the company for long-term growth. Analysts believe these competitive advantages, combined with prudent financial management, could drive the company's stock to outperform market expectations in 2025. Investors eyeing stable yet growth-oriented opportunities should consider Schwab as a strong candidate for their portfolios. LPL Financial. Leadership and expansion drive optimism. LPL Financial, another top pick for 2025, is gaining attention for its promising growth trajectory under new leadership. The company's incoming executives have outlined a clear vision centered around expanding margins and enhancing operational efficiency. This focus on cost optimization and productivity gains has already begun to resonate with investors, who see LPL Financial as a company ready to capitalize on emerging market opportunities. A critical driver of LPL's potential success is its emphasis on providing value-added services to independent financial advisors. By offering innovative tools, personalized support, and competitive pricing, LPL has strengthened its appeal to advisors looking for robust platforms to serve their clients. These efforts have translated into steady increases in advisor recruitment, which directly contributes to the company's revenue growth. LPL's expansion into underserved markets also sets it apart as a brokerage leader with a long-term growth focus. As more individuals seek financial guidance in uncertain economic times, LPL's ability to capture market share in this segment could significantly boost its profitability. Combined with margin expansion efforts, analysts believe LPL Financial is well positioned to deliver exceptional returns for investors in 2025 and beyond. Opportunities for investors. How to capitalize on the rebound. For investors looking to take advantage of these promising trends, both Charles Schwab and LPL Financial offer compelling opportunities. Schwab's focus on financial stability and achieving its NIM target provides a strong foundation for growth, making it an attractive option for risk-averse investors. On the other hand, LPL Financial's leadership-driven strategies and expansion into emerging markets appeal to those seeking high growth potential in a rapidly evolving sector. The broader retail brokerage industry is also experiencing significant shifts as companies adapt to changing client preferences and technological advancements. By staying informed about these trends and focusing on companies with strong fundamentals and clear growth strategies, investors can position themselves to benefit from the sector's potential upside in 2025. Seizing brokerage opportunities in 2025. As the financial markets prepare for another dynamic year, Charles Schwab and LPL Financial stand out as top picks poised for growth. Schwab's strategic debt reduction and focus on improving net interest margin signal a rebound that could restore its industry dominance. Meanwhile, LPL Financial's leadership-driven margin expansion and innovative approach to serving financial advisors highlight its potential to lead the retail brokerage sector in 2025. The opportunities are clear. Investors willing to embrace these strategies can benefit from the unique strengths of each company while riding the wave of broader industry growth. Stay ahead of the curve by following our updates for expert insights and actionable advice to help you navigate the ever-changing financial landscape in 2025. OpenAI's bold move. The for-profit shift towards AGI development. A new chapter in AI investment. OpenAI, the trailblazing artificial intelligence company behind innovations like ChatGPT, is making headlines with a groundbreaking corporate restructuring. Announced recently, the organization plans to transition from a non-profit to a for-profit Delaware public benefit corporation. This strategic shift is designed to attract the substantial investments needed to accelerate its ambitious pursuit of artificial general intelligence, AGI. As AI evolves into one of the most transformative technologies of the 21st century, this move not only reflects OpenAI's growth strategy but also signals a broader industry trend among key players like Anthropic and xAI. In this article, we'll explore the implications of OpenAI's for-profit transition, what it means for investors, and how it could reshape the future of AGI development. The strategic shift. Why OpenAI is going for profit. OpenAI's transition to a Delaware public benefit corporation underscores its recognition of the immense capital requirements to achieve AGI, a technology envisioned to surpass human cognitive abilities in diverse fields. Unlike its non-profit roots, which limited profit-seeking activities, this restructuring allows OpenAI to tap into a broader pool of venture capital, institutional investments, and potentially public markets. The decision aligns with similar moves by industry competitors like Anthropic and xAI, which have adopted hybrid models blending profit goals with broader societal missions. The driving factor behind this transition is the sheer scale of investment required for AGI research. Developing AGI involves immense computational costs, high-stakes experimentation, and the recruitment of top-tier talent, factors that necessitate billions in funding. OpenAI CEO Sam Altman emphasized that such a financial commitment is beyond what traditional non-profit funding mechanisms can sustain. With this shift, OpenAI is positioning itself to compete on equal footing with major tech firms and emerging players in the AI space. This restructuring, however, comes with challenges. Balancing the dual goals of profitability and public benefit is no small feat. OpenAI has committed to retaining its mission-driven ethos by maintaining safeguards, such as a charter prioritizing ethical considerations and societal well-being. This balance will be critical in ensuring that the transition does not dilute OpenAI's core values while unlocking new opportunities for growth. The competitive landscape. OpenAI and its rivals. OpenAI's move reflects a broader trend among AI companies seeking flexible structures to attract capital while maintaining a focus on societal impact. Competitors like Anthropic and xAI have similarly adopted for-profit models, aiming to secure the financial resources needed to tackle the complexities of AGI. This shift highlights a competitive landscape where success increasingly depends on access to funding and the ability to scale operations rapidly. For example, Anthropic, founded by former OpenAI researchers, raised $580 million in a Series B funding round to pursue its mission of creating AI systems that people can trust. Similarly, xAI, launched by Elon Musk, has focused on integrating AI with his existing tech ventures, further emphasizing the importance of substantial capital in the AGI race. OpenAI's for-profit restructuring positions it to attract investments on par with these competitors, ensuring it remains at the forefront of innovation. However, the shift also raises questions about accountability and the potential for conflicts of interest. Critics argue that the pursuit of profit could skew research priorities, favoring lucrative applications over public interest initiatives. As the AI industry grapples with these tensions, OpenAI's public benefit corporation model will be closely watched as a test case for balancing innovation, ethics, and financial imperatives. Opportunities for investors. Tapping into the future of AI. For investors, OpenAI's transition represents a unique opportunity to participate in one of the most exciting technological frontiers of our time. As a public benefit corporation, OpenAI combines profit potential with a mission-driven approach, offering a rare blend of financial returns and societal impact. The move also signals the growing maturity of the AI sector, where companies are increasingly seeking partnerships with venture capitalists, private equity firms, and institutional investors to fund large-scale projects. The broader AI market is poised for exponential growth, with estimates suggesting it could reach a value of $190 billion by 2025. OpenAI's innovations, such as language models, automation tools, and creative applications, are well positioned to capture a significant share of this expanding market. Investors who recognize the long-term value of AGI development have a chance to align themselves with a company at the cutting edge of this transformative field. Additionally, the shift highlights a trend towards ethical investing, where stakeholders can support ventures that prioritize societal benefits alongside profitability. OpenAI's commitment to transparency, ethical governance, and responsible AI development enhances its appeal to investors seeking both impact and returns. Redefining AI investment with OpenAI. OpenAI's decision to transition to a for-profit public benefit corporation marks a pivotal moment in its journey to develop artificial general intelligence. This bold move enables the company to secure the substantial capital needed to remain competitive in a rapidly evolving industry while maintaining its commitment to ethical innovation. By embracing a hybrid model that balances profit and purpose, OpenAI is setting a precedent for the future of AI investment. As the AI sector continues to grow, opportunities abound for investors who see the potential in this groundbreaking technology. OpenAI's leadership in AGI research, coupled with its mission-driven ethos, positions it as a compelling option for those seeking to shape the future of artificial intelligence. Stay tuned for more updates and insights as OpenAI's transformation unfolds. Follow us for the latest in financial and tech developments that are shaping tomorrow's world. Barclays Layoffs. A stark holiday reality and strategic reset. Barclays' controversial holiday layoffs. Barclays, one of the world's leading multinational banks, made waves this holiday season with a controversial move that has ignited discussions about corporate strategy and employee compensation. In an unexpected decision, the bank terminated more than a dozen bankers and traders in its New York offices just before Christmas, withholding their anticipated year-end bonuses. While layoffs in the financial industry are not uncommon, the timing and nature of these actions have raised eyebrows, sparking debates about the bank's long-term strategy and its impact on workforce morale. In this article, we examine the potential motivations behind Barclays' layoffs, explore their implications for employees and investors, and consider what this signals for the broader financial industry. Why Barclays took this path. Strategic adjustments or cost-cutting. Barclays' decision to terminate employees without awarding their bonuses has fueled speculation about the bank's priorities and underlying financial health. Some industry insiders suggest this move aligns with broader cost-cutting measures aimed at streamlining operations and enhancing profitability. The banking giant, like many others, has faced pressure to maintain competitiveness in a challenging global economic environment marked by rising interest rates, inflationary pressures, and regulatory scrutiny. From a strategic standpoint, these layoffs may also reflect a recalibration of resources. By targeting roles in New York, Barclays could be aiming to pivot toward markets or divisions where growth prospects are stronger. However, critics argue that such abrupt actions risk damaging the bank's reputation and eroding trust among remaining employees. The lack of bonuses, traditionally seen as a cornerstone of financial industry compensation, adds another layer of controversy, potentially making it harder for Barclays to attract and retain top talent in the future. Financially, Barclays' cost-cutting measures may yield short-term gains, but the long-term risks cannot be ignored. The banking sector relies heavily on human capital, and alienating a skilled workforce could lead to diminished productivity and a loss of institutional knowledge. As Barclays navigates this strategic crossroads, its approach will undoubtedly be scrutinized by employees, industry peers, and investors alike. Implications for employees, investors, and the industry. For employees, Barclays' actions have sent a chilling message about job security and the evolving dynamics of compensation in the financial sector. The timing of the layoffs, just before Christmas, has drawn criticism not only for its perceived insensitivity but also for its potential to disrupt morale across the organization. Layoffs are an unfortunate reality in many industries, but the decision to withhold bonuses has compounded frustrations, particularly in an industry where year-end payouts often represent a significant portion of total compensation. For investors, the layoffs raise critical questions about Barclays' strategic direction. While cost-cutting measures are often seen as a sign of financial prudence, they can also signal deeper issues, such as declining profitability or difficulty adapting to market shifts. Barclays shareholders will be watching closely to see whether these moves translate into improved performance, or if they indicate broader challenges that could affect long-term growth. The broader financial industry is also taking note. Barclays' actions highlight a growing trend of banks reassessing their workforce and compensation structures in response to a rapidly changing landscape. With advances in technology, regulatory changes, and economic uncertainty, financial institutions are increasingly focusing on efficiency and adaptability. However, Barclays' approach may serve as a cautionary tale, illustrating the delicate balance between managing costs and maintaining employee goodwill. Lessons from Barclays layoffs. Barclays' decision to lay off New York-based bankers and traders without awarding bonuses has sparked significant debate, shedding light on the challenges financial institutions face in balancing cost management with workforce stability. While the move may offer short-term financial relief and align with strategic shifts, it also raises concerns about employee morale, talent retention, and the bank's long-term reputation. For investors, the key takeaway is clear. Barclays is at a critical juncture where its actions today could shape its trajectory for years to come. Monitoring the bank's performance in the wake of these layoffs will be essential to understanding whether this was a necessary reset or a misstep with lasting repercussions. For employees and the broader industry, Barclays' actions underscore the importance of clear communication and ethical decision-making during times of change. Stay informed about the latest developments in the financial world. Follow us for more insights into corporate strategy, market trends, and the stories shaping the global economy. UK retail sector faces crisis. Financial distress surges amid weak consumer spending. The troubled landscape of UK retail. The retail industry in the UK, long considered a cornerstone of the economy, is facing unprecedented challenges as financial distress among retailers surged by over 25% in the final quarter of 2024. A combination of underwhelming Boxing Day sales and cautious consumer spending has exacerbated the strain on businesses, leaving many teetering on the edge of insolvency. This concerning trend reflects broader economic pressures, including inflation, rising interest rates, and waning consumer confidence. In this article, we explore the key factors driving this financial distress, examine its implications for retailers and investors, and discuss potential strategies to weather the storm in 2025. Boxing Day blues. A sign of deeper troubles. Boxing Day, traditionally one of the most lucrative shopping days in the UK retail calendar, failed to deliver its expected boost in 2024. Retail foot traffic was significantly lower than anticipated, with many consumers opting to stay home or shop online. This decline can be attributed to several factors, including cost of living pressures that have left households with less disposable income and a growing trend of early season discounts that diluted Boxing Day's impact. For many retailers, the disappointing performance was the final blow in a year marked by sluggish sales and mounting costs. The shift toward online shopping has also disrupted the traditional retail model, leaving brick-and-mortar stores struggling to adapt. While e-commerce offers convenience and competitive pricing, it also intensifies the pressure on physical stores to justify their operational costs. For smaller retailers without robust digital platforms, the competition has become increasingly untenable. The result has been a rise in store closures, job losses, and a growing sense of uncertainty across the industry. Additionally, rising operational costs, driven by inflation, increased wages, and energy prices, have squeezed profit margins. Retailers are caught in a difficult position. They must balance the need to remain competitive with the reality of shrinking budgets and cautious spending. For many, this balancing act has proven unsustainable, leading to the surge in financial distress reported in the final months of 2024. Consumer spending woes. The root of the crisis. At the heart of the UK retail crisis lies restrained consumer spending, a trend fueled by economic challenges that show no signs of abating. The Bank of England's efforts to combat inflation through interest rate hikes have increased the cost of borrowing, leaving many households prioritizing essential expenses over discretionary purchases. Meanwhile, stagnant wage growth has eroded purchasing power, making it difficult for consumers to support the retail sector at pre-pandemic levels. Data from the Office for National Statistics reveals that consumer confidence in the UK fell to its lowest point in nearly a decade during Q4 of 2024. This lack of confidence has translated into reduced spending on non-essential goods, affecting retailers across categories such as fashion, home goods, and electronics. While some sectors like grocery retail have remained resilient, the overall picture is one of cautious spending and shifting priorities. The rise of thrifting and second-hand shopping has further disrupted traditional retail channels. As consumers seek cost-effective alternatives, high street retailers are facing additional competition from resale platforms and community-driven markets. While this shift reflects changing consumer values, it also underscores the challenges retailers must navigate to remain relevant in an evolving marketplace. Opportunities for retailers and investors. Adapting to a new reality. Despite these challenges, opportunities exist for retailers and investors willing to adapt to the new reality. Retailers that prioritize innovation, customer experience, and operational efficiency can position themselves for a turnaround in 2025. For example, investing in omni-channel strategies that integrate physical stores with digital platforms can help capture a wider customer base and improve overall profitability. Collaboration with fintech solutions, such as Buy Now Pay Later (BNPL) services, could also help ease the burden on cash-strapped consumers while driving sales. Additionally, retailers that embrace sustainability and ethical practices are likely to attract a growing segment of socially conscious shoppers. These strategies require significant upfront investment, but offer the potential for long-term growth and resilience in a challenging environment. For investors, the retail sector's current distress may present opportunities to identify undervalued stocks with strong recovery potential. Companies with a clear turnaround strategy, robust e-commerce capabilities, or niche market dominance could emerge as winners in the next retail cycle. However, caution is warranted, as the sector's volatility and the ongoing economic headwinds make thorough due diligence essential. Navigating the UK retail crisis. The surge in financial distress among UK retailers is a sobering reminder of the economic challenges facing the industry. Disappointing Boxing Day sales, restrained consumer spending, and rising operational costs have created a perfect storm that threatens the viability of many businesses. However, this crisis also highlights the need for innovation, adaptability, and strategic investment to rebuild the sector's resilience. For retailers, the path forward lies in embracing digital transformation, enhancing customer value, and prioritizing sustainability. For investors, identifying companies with strong recovery potential and innovative strategies will be key to navigating the turbulence. Stay informed with us for the latest insights into the retail sector and strategies to capitalize on emerging opportunities in 2025. Steady shares for 2025. Investment experts highlight top prospects. Building stability in an uncertain market. As the global economy braces for continued volatility in 2025, investment experts are advocating for a strategic pivot towards steady shares. These stocks, characterized by their resilience and reliable performance, are seen as critical anchors for portfolios in a market defined by uncertainty. With an eye on stability and growth, companies such as Qinetiq, Pershing Square, BP, Scottish Mortgage, and RELX have emerged as standout prospects. In this article, we'll explore why these companies are capturing attention, delve into the market trends underpinning their potential, and offer actionable insights for investors looking to navigate 2025 with confidence. The case for steady shares. A safe harbor in volatile times. The financial markets in recent years have been a roller coaster of fluctuating interest rates, geopolitical tensions, and inflationary pressures. Against this backdrop, steady shares have become a beacon for risk-averse investors seeking both capital preservation and reasonable growth. These stocks are often tied to companies with robust fundamentals, proven track records, and clear strategies for navigating challenging economic environments. Qinetiq, for instance, stands out as a leader in the defense and technology sectors. With increased government spending on defense globally, Qinetiq has positioned itself as a key player in providing innovative solutions for security challenges. Similarly, BP's focus on transitioning to renewable energy while maintaining its stronghold in the oil and gas industry makes it a compelling choice for those looking to invest in energy while hedging against market unpredictability. Meanwhile, RELX, a leader in data analytics and digital information services, offers investors exposure to the growing demand for specialized data solutions. As businesses increasingly rely on data-driven insights, RELX's strong market position ensures its relevance and profitability in the years ahead. These steady shares exemplify how strategic selection can help mitigate risks while unlocking growth opportunities in uncertain times. Spotlight on key players. Qinetiq, BP, Pershing Square, and more. Each of the highlighted companies brings unique strengths to the table, making them attractive choices for a diversified investment strategy in 2025. Qinetiq's innovation in defense technology aligns with global trends, emphasizing national security and cybersecurity. Its steady contracts with governments worldwide provide a reliable revenue stream, ensuring long-term investor confidence. BP, on the other hand, represents a balanced approach to energy investments. While oil prices remain a critical driver of its revenues, BP's investments in renewable energy and carbon-neutral technologies signal its readiness to adapt to the energy transition. This dual focus not only hedges against traditional energy risks but also positions BP as a leader in the green energy revolution. Pershing Square, a hedge fund founded by Bill Ackman, offers exposure to a diversified portfolio of high-quality, undervalued companies. With its history of strategic investments and activist shareholder strategies, Pershing Square provides a steady yet opportunistic avenue for growth. Meanwhile, Scottish Mortgage, an investment trust with a focus on innovative global companies, offers exposure to high-growth sectors like technology and biotechnology, balancing stability with significant upside potential. Actionable insights for investors. Building a resilient portfolio. For investors, 2025 is shaping up to be a year where resilience and strategic planning take center stage. Allocating a portion of your portfolio to steady shares such as Qinetiq, BP, and RELX can provide the foundation for long-term stability. These companies, backed by robust market trends and strong management, offer a mix of reliable dividends and growth potential, making them ideal for risk-conscious investors. Diversification remains key. Pairing steady shares with growth-oriented investments like those found in Scottish Mortgage or Pershing Square can help balance risk while maximizing returns. Additionally, monitoring macroeconomic indicators, such as interest rate changes and geopolitical developments, will be crucial in fine-tuning your strategy. Staying informed about industry-specific trends, such as the shift toward renewable energy or the rising demand for data services, can further enhance your decision-making process. Leveraging financial tools like ETFs or index funds that track steady shares can also streamline your investment strategy. These options provide exposure to multiple companies within a single investment vehicle, reducing the risks associated with individual stock selection while ensuring consistent performance. Positioning for growth and stability in 2025. As 2025 unfolds, steady shares offer a reliable pathway for investors seeking stability in an unpredictable market. Companies like Qinetiq, BP, Pershing Square, Scottish Mortgage, and RELX exemplify the potential to balance risk and reward through strategic investments. With strong fundamentals and alignment with emerging market trends, these stocks are well suited to anchor portfolios and deliver steady returns. For investors, the message is clear. Prioritize resilience, diversify intelligently, and stay informed about market dynamics. By focusing on steady shares and leveraging expert insights, you can navigate the challenges of 2025 with confidence and poise. Stay tuned to our platform for the latest investment strategies, expert analysis, and actionable tips to help you make informed financial decisions.